Something unsettling is happening in the global economy right now. Not just another bubble, not another overheated stock market. This time, the warning signs match almost perfectly with the signals that came before every major collapse of the past century. And the loudest part? The safety nets that saved us in 1929 and 2008 aren't strong enough to save us again. Today, we're looking at 5 major warnings, each dangerous on its own, but together forming something far more serious. A system that's starting to shake from multiple sides at the same time. Let's start with the first one. Warning 1. A market held up by 7 companies. The stock market looks strong. The headlines look calm, but underneath the surface, the foundation is thinner than most people realize. 7 companies: Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla now make up around 30% of the entire S&P 500. That level of concentration isn't just unusual, it's a structural weakness. Because here's the problem: when a small group of mega companies carries the entire market, even one stumble can trigger a chain reaction. If earnings disappoint, if AI hype cools even slightly, if growth slows, the entire market moves with them. Nvidia alone carries about 7% of the index, and valuations only make the picture worse. The S&P 500 trades at around 28 times earnings, almost double its historical normal range. Nvidia trades about 65 times earnings, a level that only works if the future unfolds perfectly. But even if stocks weren't stretched, the second warning sign shows why this moment is more dangerous than past cycles. Because this time, the risk isn't limited to Wall Street. Warning 2. Housing isn't safe anymore. People keep saying the housing market is strong. Prices are high, demand is high, supply is low. But that's only the surface. The deeper reality is far more fragile. Home prices are now about 50% above long-term affordability levels, higher than the 35% peak before the 2008 crash. Affordability is broken, buyers are disappearing, and the market is being artificially held together by one shaky factor: homeowners refusing to sell because they don't want to lose their low mortgage rates. But the real stress isn't in residential housing, it's in commercial real estate. Across the country, offices are sitting half empty. Buildings financed at 3% now have to refinance at 7 to 9%. And those numbers simply don't work. When a building can't produce enough rent to cover new debt payments, owners walk away. And when they walk away, banks take advantage. We are already seeing the cracks. Vacancies above 40% in major cities. Property values down 40 to 60%. Billions in loans coming due in 2025 and 2026 with no viable refinancing path. And when commercial real estate breaks, banks are next. Which leads to warning number 3, the one many experts are most worried about. Warning 3. The bond market is flashing red. Bonds are supposed to be the boring part of the financial system. Safe, predictable, the place investors go when they want stability. But now, bonds are acting like they've reached a breaking point. The US government owes $36 trillion, and that number is accelerating. To keep the system running, the government must issue more and more bonds. But investors aren't buying them the way they used to. That forces interest rates higher, and when interest rates rise, the value of existing bonds falls. Banks lose money quietly, pension funds lose money quietly, and the government pays more just to keep the lights on. The annual interest bill is now over $1.2 trillion, the largest expense in the entire federal budget. More than Social Security, more than defense. When interest payments rise this fast, the government has only 3 options. 1. Cut spending hard. 2. Raise taxes aggressively. 3. Print money again. Every option leads to economic pain, and none fix the underlying problem. But the fourth warning sign takes this from serious to system-level dangerous, because it hits every household whether they invest or not. Warning 4. Consumers are maxed out. Most people don't realize how stretched the average household has become. Credit card balances, all-time highs. Auto payments, all-time highs. Rent, all-time highs. Student loan payments, fully returned. Credit card interest now sits between 21 and 28%. Auto loans stretch to 84 months. The average credit card balance is over $6,800 per household. Here's why this matters. The US economy relies on consumer spending for 68% of its activity. When households stop spending, the system slows fast, and the signs are already here. Credit card delinquencies resemble 2011. Auto loan delinquencies resemble 2009. Student loan delinquencies are rising exactly as experts predicted. But here's the twist that almost no one talks about. In 1929, only 10% of Americans owned stocks. Today, 58% do. That means when the market fails, retirement accounts fall instantly. More than half the country takes the hit all at once. And that brings us to the fifth and final warning sign. Historically, the most accurate recession indicator ever discovered. Warning 5 has never been this clear. There's one rule in economics that has held true for over 70 years. When the yield curve inverts, a recession follows. Every time, zero exceptions. The yield curve inverted in July 2022 and stayed inverted for more than 2 years, one of the longest and deepest inversions in modern history. It finally normalized in late 2024. And historically, recessions begin 3 to 12 months after the curve uninverts. That puts the danger window between late 2025 and late 2026. And that timeline aligns perfectly with commercial real estate refinancing, consumer debt hitting its limits, stretched stock valuations, rising bond market stress, banks holding unrecognized losses, AI hype cooling, insider selling surging, Warren Buffett holding record cash levels. These signals are no longer isolated warnings. Together they look less like a possibility and more like a schedule. This topic has sparked a lot of debate, and we're genuinely curious how you see it. Do these signals look connected to you? Or do you think the fears are overblown? Let us know your view below. It's always interesting to compare perspectives. What happens when the spark hits? Every crash has a beginning. Sometimes it's dramatic, sometimes it's silent. But this time the danger isn't one event. It's the way these 5 forces feed into each other. A drop in tech stocks shakes the market. A weaker market hits household spending. Failing spending hurts businesses. Businesses cut workers. Job losses hit housing. Housing stress hits banks. Banks pull back on lending, and the cycle accelerates. Crashes don't start with panic. They start with hesitation. Buyers step back. Lenders tighten. Investors wait instead of acting. And that hesitation is already visible. If the past 100 years of data mean anything, the next major recession isn't decades away. It's not someday. It's lining up exactly where the numbers say it should. 2025 to 2026, right inside the danger window the yield curve keeps pointing to. So the real question becomes, are we looking at a system that can still steady itself? Or have we already stepped into a moment that only ends in a financial reset? Let us know what you think in the comments below. And make sure to like and subscribe. We've linked sources for several of the facts mentioned in the description. Thanks for watching.